so today is I would say, the fourth class, which is more than halfway through already. The agenda for today is to go through the notes. Hopefully, it's a bit heavy, I would say. So just bear with me, especially there is a good portion on theory. So, if there's any question, do stop me, because that theory part can be a bit complex, but don't worry, we'll try to dissect the information and the theory, and we try to understand it in the most simple sense, right? In the most like layman term. So besides that, we'll go through also the TMA questions. And like I mentioned earlier, the TMA will be released at 12 midnight today, because there is a requirement that it can release at 12 midnight. So I couldn't release the paper for this class so that you all can look at the mistakes and all those things, right? But don't worry, overall the class did very well. I think we have quite a few number of people, scoring almost like 95 or 80 marks. Yeah, like really high marks. Like you just got like 1 or 2 mistakes. So very good in general. All right. Okay. So let's kickstart the lecture. We'll do the same format. We have 2 breaks for every hour. And in between, if there's any questions, feel free to type in the group chat. I also encourage you to unmute yourself if you'd like to. If not, it's fine. You're like a monologue. All right. Okay. So today we are talking about cost of capital. So as usual, I'd like to give you all what's the idea behind cost of capital before even we go into details of all the integrity stuff, right? Calculations and all. So the idea is for cost of capital is that for every firm, for every company, whenever they raise capital, so when we say raise capital, right, we need to think of 2 components, shares and debt. So when they raise shares or raise debt, meaning that they are like getting more debt or getting more or issuing more shares, get more money, basically at the end of the day, get more money. So when they raise capital, basically get money, they have various considerations. And the consideration is based on this idea of cost of capital. So what is the cost to the firm to raise capital? And so we'll look at various formulas to calculate what is the cost to the firm. And there are multiple types of costs, right? So it's not only financial costs. Later we'll look at taxes, we'll think about bankruptcy costs, indirect and financial costs, business risk, financial risk. So there are various costs relating to the type of capital that the company raised. And the idea behind it is, at the end of the day, for this today, is just to calculate what is this cost of capital for the firm and to consider various factors, right? So we'll look at a theory and various propositions by the theory to explain how these various costs affect the cost of capital, right? So that's the broad overview, right? And then now we'll go into a bit of more details. Okay, why is the cost of capital important? So the basis is that depending on whether the cost of capital for the firm is high or low, the firm will have to invest in certain kind of projects. Maybe if the cost is very high, the firm must invest in a less risky project, right? If the cost is low, then the firm can take on a higher risk, right? So basically, you're trying to balance the risk. And in the last lecture, we talked about risk and return. So it's the same thing, but now we're looking at the firm level, right? We're not looking at investor level. The last lecture, we talked more like investor level, we talked about various like diversification and all. Now we're going into the firm and looking at their risk and return kind of profile, and we try to determine what's the cost of the firm. All right. So that's the broad overview. So now, let's go into the details, right? Let me just pull out the usual, my pen. Okay, so basically the idea of cost of capital, like I mentioned, so it's a small repeat, is that it's the return to the providers for the funds, right? And when we look at cost of capital, it basically means the discount rate. So sometimes you see what is the cost of capital, what is the required rate of return, what is the discount rate. So these are all the same thing, right? Just that there are just different terms. So now what we're doing is we're actually calculating the discount rate required to do your time value of money to do various calculations. But now we're doing the calculation of the discount rate. Previously, most questions, they always give you the discount rate, but now we're doing the calculations for it. And the idea behind it is that the firm must at least earn the minimum required return, which is equal to the cost of capital, right? If not, if you are earning less than the cost of capital, then maybe you shouldn't even do that business or do that project, right? So you must at least earn the minimum amount of the cost of capital. Okay. And at the end of the day, the cost of capital is related to the risk profile, and how the market determine the risk. So like in the last lecture, we talked about risk and return. So it's the same thing. If the higher the risk, that means the cost of capital will be higher. All right. Okay. So in the cost of capital, earlier I mentioned there are two components, equity and debt. Okay. For equity, right, we will look at two types of equity. We'll look at normal shares, kind of equity, and preferred shares. And we'll look at the calculations. In fact, actually, we have already done the calculations previously. So this is just a bit of more recap, right? So now let's look at cost of equity. So the cost of equity basically is the cost to the equity investor or equity holder. And generally, between these there's a broad idea that the cost of cost of equity and cost of debt, the cost of debt is generally lower. We'll see why later, but you just put that in the back of your mind that, you know, between cost of equity and cost of debt is lower, meaning that the company will actually want the cost of debt, but we'll see in what situations, right, later. And there are two major ways to calculate the cost of equity. The dividend growth model, and this was covered in lecture 2, and the CAPM model, or SML line, that we kind of did in detail last lecture. So this is in lecture 2 and this is lecture 3. But we'll just do a quick recap about it, how we calculate. So if you just flip back to your notes on lecture 2, we talk about this Gordon growth model or dividend growth model approach, and we actually did, I think, 1 or 2 calculations, and even in the lecture 2B, we also had some questions, or 1 or 2 questions on it. So basically it's the same thing, right? We are using the idea of a growing perpetuity, which is given by here, but we shift the formula and we get this. So it's exactly the same as lecture 2. If you go flip back to your notes, you'll see this formula, and we did a few calculations. So the idea being that we take D1 divided by P0, right? D1 meaning the dividends for next year. I hope everyone remember, we did a question saying that, oh, is dividend now or dividend for next year? And if it's now, then we need to multiply it by 1 year, right, of the growth. So we'll see a few questions here today as well. That's for recap. Then you plus this G. I want to highlight to you for this G, recall how we calculate the sustainable growth rate. Remember the sustainable growth rate? Anyone recall what is this sustainable growth rate and how do we calculate this? Anyone remember sustainable growth rate? So remember, the sustainable growth rate is the ROE multiplied by the retention ratio. So just remember that we can use that formula to calculate G, just in case, you know, certain questions, I think your finals, because your GBA probably, you know, you will not use this, but just know that in order to calculate G is just not like a random thing that appear, right? You can actually calculate it using the sustainable growth rate. Okay. All right, so we do have a question here, just as a recap. Hopefully it's not new. So we have a company that expects. So expects meaning that is a D1 already, which is good. Expect to pay dividend of 4.4 next year. It's next year, so it's good. Dividend growth at steady rate of 5.1%. The market expects to continue paying dividend, and then the current stock price is this. So cost of Equity, basically we just take 4.4 divided by 50, which is current stock price, plus 5.1%. Right? Then you should get this answer. Everyone okay with this or very comfortable with this calculation? This was done in lecture 2. Yeah, okay, that's good. All right, so because we are using the growing perpetuity formula, right? So remember earlier I mentioned about sustainable growth rate. That is one way to calculate G. Alternatively, we can calculate G using a very, I would say, rudimentary approach where we just take the simple average. So this is the growth of the dividends by, this is what, how many years? 5 years. And then you just take an average of it. That's 5.1. So this is another way to calculate G. So, look at the question carefully, like what information they give you. If they give you information about ROE, what is the dividend payout ratio, then you think about sustainable growth rate, right? But if they give you like, I guess, the difference in dividends for each year, like this, and then you can calculate G using just the average. So just put in the back of your mind that there are actually 2 methods to calculate G. All right, so there are some disadvantages, advantages. You can look at it, not too important, but the main thing is that only companies that are paying dividend, we can use this approach. So if the company doesn't pay dividend, then we can't. And if you notice, I'm just going to flip back to the formula here. You notice that this G is very important. That's why I keep on emphasizing, you can use this way to calculate it, that way to calculate it, because we're actually adding a number there, right? So let's say if you erroneously calculate G as like 10%, but actually maybe it's only 5%, they are adding 5% additional, which is quite substantial, right? So because of that, this model, is still being used, but it's being affected by G a lot. So we need to be very careful when we use this formula. Okay, we have just another practice question. So Low Techco issued a dividends, just issued. So just being D0, right? I hope everyone knows that already. D0 company expects to maintain a 6% growth rate, dividends indefinitely, stock is going to sell at this, right? So we just plug in the standard formula, 1.06 divided by 41 plus 6%, right? So everyone can get this. Okay, so that's just a bit of recap. This is also another recap. We learned this CAPM model last lecture, so perhaps this might be even more familiar to you, or more because it's more recent. So remember we did this CAPM model and we talk about the SML line. It's a very bad line. The SML line being like this, and then we say this model only predicts the stock or the company at the point on the line, right? Because all companies must fall on the SML line, right? If you are above or below, means that you are not at equilibrium, right? And then we talk, just want to recap. Remember we shared about the systematic risk. So the SML line kind of only shows a systematic risk because all unsystematic risks are being diversified fully, right? So yeah, try to remember those points. We talked about beta and how beta was the measure of systematic risk. Beta of 1 being like the market beta, and beta of 0 being risk-free. So all these are just recap, right? All right, so we can use the CAPM model to calculate this. We are given market risk premium. Remember, this is important because if the question gives market risk premium, we don't have to minus risk-free, right? So this one here. So this is market risk premium. So if they give market risk, then it's just this, right? This is market risk. This minus this is market risk premium, right? So that's the different terminology. Okay, so with this, we can do some calculation. 3% plus 1.2 times 6%, and this should give us this answer. So I'm going a bit faster here because these are orders recap. That I will go slower at the part where it's like new and all. So I know if it's too fast, do let me know as well. Advantages and disadvantages is basically the advantages and disadvantages for using an SML line, which we mentioned a couple of times. That the disadvantages can include that you have to fully diversify your portfolio, no more unsystematic risk. The company is at equilibrium, but for example, if the company isn't at equilibrium, then we shouldn't use this model, right? Of course, we must estimate beta, and also there are the parameters that we use should be more forward-looking parameters. But most of the time, this is quite difficult to do. So we use more historical data for this. So it might not be too accurate, right? Because we are forecasting that whatever happened in the past will happen in the future, but might not be the case. Right? Applicable as long as they have beta of the company, which is most of the case, yes. And of course, we adjust for systematic risk. All right. So this question, we are now using both approaches, the dividend growth model and the CAPM approach, right? So we're given a couple of information here. So we have a stock with beta 0.9, market risk premium 7, T-bill. So anyone recall what is the T-bill in this T-bill? T-bill is currently yielding 3.5%. So what does this T-bill mean? Most recent dividends paid at 1.8, dividend expected growth at 5%. Current stock price is 47. So anyone knows what is this T-bill or recall? Yeah, but what does it represent? For this treasury bill? Yeah, correct, risk-free. So I think last lecture I did mention that sometimes they don't explicitly say risk-free, but if they say T-bill, that's risk-free. Perfect, that's great. All right, so CAPM, what do? We do 3.5% plus 0.9 times market risk premium. Perfectly give us market risk premium. So this should give you this answer here. If you use the dividend growth model, let's see, what do we get? So most recently paid dividend. So that means we need to concede, this is most recently, this is D0. So we need to do D1, right? So 1.8 times a 1.05 divided by 47 plus 5%. Right. So this should give you this answer here. And we do the average of that. Simple average, meaning we just add this plus this divided by 2. Okay. Right. Okay, so those two methods are basically the way to calculate the cost of equity. Now we're going to calculate the cost of debt. And in particular, we are going to focus on bonds. Again, this part is actually a repeat of lecture 2. So I might go a bit faster as I mentioned, because it's just a repeat on how we calculate bonds. But before we calculate the bonds, yield, we will talk more about bonds. I think in lecture 2, we did mention bonds, but it was just quite brief. So if you are very familiar with bonds, this will just be a quick recap, right? All right, so for bonds, what are we doing? So bonds are debt instrument, and maybe I'll explain to you the concept of bonds again, right? So bonds are basically a piece of, I like to call it a piece of paper, where a company, first of all, is looking for some money, right? The company needs some money, cash in particular. And so they would go out to the market and approach, let's say you and I, let's say approach you, and then they promise, like they'll give you a piece of paper, say like almost like an IOU, where they say, okay, you know what, can you pass me, let's say, $10,000, and I give you this piece of paper. All right, so you take the piece of paper and you get the interest on the bond in terms of the thing we call coupon payments, right? Coupon payments meaning that they're like maybe semi-annual payments or annual payments to you, and that is kind of your interest on your bond. And then at the end of the day, after maybe 3 years, you take the piece of paper, return the piece of paper to the company, and the company gives you back your principal amount, right, of 10,000, and the bond cease to exist. It ends there, right? So that's basically a bond. The interesting part is that the interest comes in terms of coupon payment, and that, like I mentioned it previously, if you recall, is the most basic bond. Then now we'll look at some different bonds and some fancier bonds. All right, so that's the basic bond. Everyone okay with the concept of a basic bond? Because now we're going to add in more like details and all those things. Yeah, perfect. Okay, good. So just want to mention here that bonds are traded only over the counter, meaning that like on a market, all right, in the market or privately between borrowers and lenders. Okay, so maybe I'll not go through this. This is just a repeat. You can look through it. Okay, in terms of default, the bond default when the company is not able to pay you your coupon, or the company is not being able to pay you the principal, meaning at the end of the thing, at the end of the bond, when it matures, the company is not able to give back your 10,000 that you loan the company. But the interesting thing about bond is very similar to debt instrument, where at maturity, usually the company do not so-called close the transaction. Close the transaction meaning that do not return your principal and seize the bond. Close the transaction. So usually that doesn't happen in real life. What happens is that the company, like 1 year before expiry or maturity of the bond, the company will go out to the market again to issue another bond. And they'll use these proceeds of the bond to pay off yourself or myself that have lent the company on the original bond, right? That's how the company does. So it's almost like a refinancing. So usually the company do not pay back the principal. They just keep on rolling the bond over and over again, right? And so yeah, that's the reality of how the company works. And so they maintain that debt profile almost forever, unless they have a strategic decision to like reduce their debt and everything, right? Then they might pay off the bonds. All right, there's a few kind of bonds. Corporate bonds issued by companies that we talk about, municipal bonds issued by the state. So this is more like relevant for like the US and like Canada, where we have states and municipalities. In Singapore, not really. Government bonds is very common, even in Singapore. Like if you are familiar with LTA, SP, Singapore Power, they issue government bonds quite regularly. And there are some terminologies used here where T-bill is less than 1 year, a note is 1 to 10 years, and bonds are like beyond 10 years. This is some terminologies, right? Oh, sorry. The LTA and all, they are considered agency bond. Government bond is from the Singapore government. Yeah. Anyone is following the bond market or is following the news about like finance and stuff and know what's happening to the bond market now? Because that's an interesting development. Yes or no? You're not too interested in the bond market or news about the bond market. Okay, okay. Just for fun, maybe I'll just share a bit. This is more like practical kind of information, right? So, oh, okay, maybe I'll share it later after these few slides, because we'll talk about some characteristics of bond that it'll make more sense to explain this. Okay, so let's continue first. In terms of the bond, remember we kind of made a few calculations on how we do the bond calculation, where we did time value of money, and there's like the issue price, which is the PV, usually the PV, the face value is the FV that we always every time use, and most of the time 1000. And coupon rate, remember coupon rate is different from the yield to maturity. Coupon rate is for that coupon payment. So this coupon rate is how we calculate the coupon, or the PMT. We take the coupon rate times the face value, right, which is usually 1000. Now, in terms of the yield, remember we used to calculate the yield, or I. This is the yield to maturity. And of course, the maturity date. So the yield to maturity basically is the interest on the bond, right? Based on the time value of money calculation, we can pull out or derive the interest. Maturity date is, of course, how long the bond. So these are just repeat. So I'm just going a bit faster. And of course, if there's any questions, there are parts that are too unsure, do stop me. Yeah. Okay. So in terms of determining coupon rate, so coupon rate, remember, is the PMT. Yeah. We are talking about the PMT component. So in terms of the PMT component, we have two key things that determine the coupon, which is basically the interest that you get. Remember, because bond, the way you get interest is through coupons. So first of all is the time to maturity and the credit quality. Basically, a longer maturity will give you higher coupon. Why? Because you're putting the money there for longer, right? So it's like the same thing as like a loan or maybe a fixed deposit. If you are putting the money in the bank for a longer time, you will be compensated more. Same thing. So if the bond is longer, you'll be given a higher coupon. All right. Of course, that is because of basically some risk, some inflation or opportunity cost, right? But the basic idea is that, oh yeah, you put money longer, you get more money. Now, in terms of credit, so the bonds are usually rated based on the credit scale. The higher the credit risk, that means the more risky the bond, the higher coupon you should get, which is in line with the risk and reward, right? If you're taking on more risk, you should get more reward. So that's the same thing here. So this is just a pictorial version. Maturity increase, yield increase, right? Yield meaning the, remember yield meaning the coupon rate. So it's the coupon rate, PMT. But remember your PMT, right? At the end of the day, if you use time value of money, it will determine your I, which your yield to maturity or the interest on the bond, right? Because how the bond works, probably repeat too many times, but how the bond works is that you get the interest. Your interest on the bond is basically from your PMT. Okay. All right. So this is the second part of the coupon rate determination, which we mentioned is the credit risk. So nowadays there are many types of companies that does rating. We have Moody's, S&P, Fitch. So they all do ratings. And basically anything is rated above B are considered investment grade. So we have a scale here where we can look. So we can see that anything that is here, the A category, is more or less, kind of like investment grade bonds. Yeah, so here. So the idea being, the more risky the bonds, the lower the yield, right? Or the lower the coupon, because you're taking less risk, less reward, right? The higher the risk, of course, the higher the coupon. All right, so this, I think we mentioned this concept previously, but I would like to repeat it. And this is the most important concept for the bonds, is that bond is inversely proportional to interest rate environment. So now we're talking about interest rate environment. So price is inversely proportional to the interest rate. So what does this mean? If the interest rate decrease, right? Interest rate decrease, like here, it's going here, the bond price actually increase. On the reverse, if the interest rate increase, right, this way, the bond price would decrease. And I think now it's the good time to mention about this small, not very small, but like a development in the bond market nowadays, right? And we know that interest rate environment, even in Singapore, has been increasing. Why? We see that our fixed deposits are getting, they are yielding more, right? Like if you go to a bank now, I think the fixed deposit rate is very good, like 2% or maybe even 3% now. I'm not very following, but it has been increasing a lot. That's because the interest rate environment has been increasing. If any of you have a house or bought a home, you know that your mortgage loans are very expensive because of high interest rates, right? And that is the issue with bonds, because remember, when interest rate increase, what happens to the bond price? The bond price decrease. And what does this mean? Imagine if you are holding a portfolio of bonds. Remember, we talked about portfolio of stocks last lecture, but now let's just imagine you are only holding bonds, nothing else, no stocks. What does this mean? It means your portfolio becomes worthless when the interest rate drops. So actually, this is what happened if you follow the financial news, this is actually what happened at Silicon Valley Bank, which is a bank in US, Silicon Valley. Yeah. So what happened is that they were holding a portfolio of government bonds, which are typically considered risk-free, right? Remember, we mentioned T-bills. So T-bills are bonds but short-term. So they are holding government notes. So notes are, remember, 1 to 10 years, right? So what happened is that they were holding these notes, which was a big portfolio of the big composition of their portfolio. And because interest rate keep on increasing, the bond price keep on decreasing. So the bond price keep on decreasing and their portfolio become worthless. Meaning what? If I go to Silicon Valley Bank now and want to take out my money, they don't have money, right? Because their investments are worthless. So that's what happened, right? So this is a bit of a news on bond, and which is why this idea of bond and interest is a very important relationship. So if any of you are like even more interested in this idea of bonds and how do we mitigate this kind of risk, I think if you take more advanced finance course in the school, we'll cover that even more detail, and it's quite interesting if you are interested in this kind of finance stuff. All right. Okay. So there are various bonds that we talk about. There are various types of bonds. So we have these bonds called a zero coupon bond. Remember, so far the vanilla bond that we talk about has always been giving coupons, right? Coupons, but not only that, the price at the end is kind of fixed at 1,000, right? We sometimes say FV is 1,000. But we have various types of bonds where, first of all, it can be zero coupon. So meaning what? How does this zero coupon bond works is that the price you pay now for the bond is different from the amount that you loan to the company, or the amount that the company will return you. So basically, it's almost like a loan. So for example, you give the company 900 now, and then at the end of the day, the company will return you 1,000. So there's no coupon in between, nothing. And the growth is just due to the money growth that you get at the end. So that's like an example of the zero coupon bond. Callable bond means that, okay, so how I like to remember this is, if it's callable, means what? That means the issuer or the company can call the bond back. So imagine call back the bond. And this will give callback, meaning what? That means I take back the bond from you. And this is disadvantageous to you, right? It's not fair for you. Like the company can just take back the bond. What if I don't need the money? I want to get more interest, right? So because it's a callable bond, the interest the company have to pay you must be higher because it's not good for you because the company can just take back the bond, right? So that's how I like to remember this kind of concepts, right? So callable bond means that the company can just call or take back the bond, and this is bad for you. So you should be compensated more, right? Now, the second one is puttable bond. So how I like to remember this is that you having that piece of paper, remember the bond is a piece of paper, you can put that piece of paper out in the market to sell. So that's how I like to remember. So put is you put out the paper to sell. Meaning what? If you can actually sell the bond to someone else, isn't it advantageous to you? Like, for example, tomorrow I need some liquidity, right? I need some money now. I need some cash. I can just take this piece of paper and sell it to someone else. So it's like a puttable bond. And this gives you some advantage. And because of that, the company knows that you have an additional advantage. And so the interest they give you on this puttable bond will be lesser. All right. Everyone clear with this concept of callable and puttable? So the good thing is that it's open book, so you can still flip through your notes during exam. But sometimes it might be quite. The questions can be long, right? So you might not have time to just keep on flipping through. So it's good to also remember a bit of like the general concept. Yes, I guess you can think of it as opposite in terms of the benefits of this special function. So the callable bond is benefiting the company, right? And the puttable bond is benefiting yourself, the bondholder. So yes, you can think of it as opposite. In terms of this sinking provision fund, I think last GBA or finals, they actually tested on these sinking provision funds. The idea of these sinking provision funds being that the company will be forced or agree to set aside certain amount of money to pay off the bond's future value. Remember, at the end of the day, the company, when you take the piece of paper, you have to give the company the piece of paper, and the company will return the amount that you loan to him, right? Him or her. So the thing being, if the company is unable to return the lump sum that you lend to a company, then the bond goes into default, and that's very bad. So sometimes how do we mitigate this issue is that we agree with the company to say you have to put in place this sinking provision fund. This is to protect who? Is it protecting the issuer of the bond, or is it protecting the bondholder? Which one? So is a sinking provision fund protecting the bondholder or the issuer of the bond? Yes, the bondholder, that's right. Because when the bondholder goes to the issuer of the bond, which is the company, he will know that because of this agreement, the issuer will have the lump sum of money to return the bondholder. That's right. So in that sense, right, the sinking provision fund and the puttable bond actually protects or give benefit to the bondholder. The callable bond give benefits to the issuer, right? So that's how we can think about this. Okay, now we have even more bond characteristics. So we are going quite into detail of the type of bonds. We have this thing called a premium bond. So what's a premium bond? So a premium bond, the easiest way. So if you see a question, right, you don't even need to think whether it's a premium or discount bond. We just first of all focus on coupon rate versus yield to maturity. Remember, both are different. The coupon rate. So just be very careful. Don't mix the coupon rate and yield to maturity, right? They are different things. So if we look at the bond details, if the coupon rate is more than the yield to maturity, it is a premium bond. Straight away, you can just say that. Now, if the discount bond is, the coupon rate is less than the yield to maturity. All right. So what does this premium or discount bond means? Okay, let's look at this graph here. So imagine this flat line being the normal bond. Normal bond meaning that it's not a premium, not a discount. All right. So a premium bond, so this is a normal bond, that's right, norm. So it's just a normal bond. It's not premium, not discount, nothing. Now, for premium bond, what happens is that the bond will be sold at a higher price, at a premium. All right. So what will happen during a premium bond's life is that the bond price would decrease towards the normal bond like this. So at the start, it is sold at a premium. Over time, it will just drop. All right. So that's why I say bond price is more than par. Par meaning par is the normal bond, the standard. As the usually is 1,000. Right. So at the start, maybe it will sell for 1,600. So bond price decrease over time until par value. Now, a discount bond, on the other hand, it means that the price will increase over time up to the same point here. Maybe this one is, I don't know, 500. You pay 500 and then over time it will increase. So this is called a discount bond, right? So I'll repeat again, the best way to determine whether it's a discount or premium bond is simply to just look at coupon rate versus yield to maturity. And it's always true. So regardless of the type of bond, if you just focus on coupon rate and yield to maturity, coupon rate is less than yield to maturity, is a discount bond. All right. Now, we have another kind of bond, which is the idea of a negative yield bond. So this concept of a negative yield bond is common in Europe, where usually government bonds that I think issued can be negative yield, and people will still buy it, right? So this example is a German bond. Oh, it's a spelling mistake. So it's a 30-year German bond, zero coupon, all right? Face value of this 100 euro, and it's sold for this. Can you see that this is it's sold at a higher price, and you get back lesser amount of money, and there is no coupon, right? So this is quite bad, right? Imagine you're giving the company $103, and maybe after 30 years, you get back $100, which is like lesser than what you loan the company, right? So it might be a bit counterintuitive, like why would I do such a thing? And so the reason can be, first of all, sometimes certain investors buy this bond to achieve a certain asset purchase target. So what does it mean? It means that their portfolio, they want to, let's say the portfolio is a pie, right? They want like X percentage, let's say 25% in this German bond, something like that. They want a certain target. So they have no choice to buy discount bonds. And of course, the issuer, meaning the German government here, knows that there are some people that really want to buy their bond. So they are happy to make their profit from that. Of course, another way is that this negative yield bond, the bondholder, right, will kind of is expecting that yield to fall. Remember, when yield fall, what happens? What happens to price when the yield fall? Anyone knows? One of the thing that we talk about, when yield decrease, price of the bond will decrease or increase? Price increase. Perfect. Yeah, it's inversely proportional, right? Inversely proportional to price. Perfect. Yeah. So they kind of, people that buy this kind of negative yield expect yield to fall, then the price will increase, so you can make a profit. All right, so those are like, wow, we talk a lot on the concept of bonds. And basically, it just trying to help you kind of understand bonds more. But what we want to do from this concept of bond is actually to calculate the cost of debt. Remember, at the end of the day, right, we are talking about so many things. We are trying to calculate the cost of capital for the firm. And one of the ways, or one of the things that the firm does is to issue bonds, and bonds are debt instrument. And so we can use the bonds to calculate the cost of debt. And the method being, we can use the yield to maturity. So basically, we compute yield to maturity of the bonds, and the yield to maturity gives us the cost of debt. This is very important here. I'll put a big star that the cost of debt is not the coupon rate. Is not. So this is very important. So sometimes maybe you know the concept, but questions can be very long-winded, a lot of information. So just be very careful when you read the question. Understand which is the coupon rate, which is the yield to maturity, and the cost of debt is the yield to maturity of the bond. Now, another important thing to take note is that debt is tax deductible. So, for example, if your cost of debt is 5.2%, we can actually deduct a tax of 35% here. And what does this mean? It means that it decreases the cost of debt, which is why earlier I mentioned that the cost of debt is usually lower than the cost of equity, because equity do not have this tax deduction. Right? For debt, there is a tax deduction here. And I would like to introduce this concept of tax deduction being the idea of a shield. So it's called tax shielding. So you're actually shielding the company, shield meaning the kind of shield that Captain America used and all, but it's like a shield, right? So it protects the company by reducing the amount of expenses, right? So we'll look at more details on this shielding effect of debt, but just think of it like a shield because it actually reduces the cost of debt for you. So it shields the company from the cost. All right. Okay, so we have a simple calculation. I hope all of y'all will be able to get this by now because we did this in lecture 2. Important thing to take note is that what's happening. Coupon is paid semi-annual. If it's paid semi-annual means what? We need, remember when we do time value of money, we always convert it to the lowest denominator. Lowest denominator means what? If it's yearly, semi-annual, we always do semi-annual, right? If the question has 2 things, yearly and semi-annual, we do semi-annual. That means we convert everything to semi-annual. So in this case, we have to convert everything to semi-annual. You never go upwards. You never convert everything to annual. Why? Because by doing that, we need to consider compounding, and it becomes very complicated. Compounding meaning what? We need to compound. We cannot just multiply by 2. We need to compound it up. All right, but okay, so now we are doing everything semi-annual. So N is 15 times 2, all right, because 15 years. Coupon rate, so PMT, is 12% multiplied by 1,000 divided by 2. FV is 1,000. Oh, I want to highlight to you also that if the question, like in this question, did not tell you what is the FV, it is assumed to be 1,000. All right, so this is an assumption that you need to know that if question did not say what is the FV, what is the par value of the bond, is assumed it's 1,000. PV, remember this is negative. Everyone knows why it's negative. So this is very important. If you put the negative positive wrongly, you will get the wrong answer. So everyone's okay with why is it negative? Yeah, that's right. Money is going out of your pocket. Perfect. And we do CPT, compute IY, right? Or we use the rate function in Excel, RAT, rate. Rate, then we put in the details here in Excel. Okay. So, yeah, important thing, PV is negative because, yeah, money is going out of pocket because you paid. That's right. Okay. All right, we have one more question regarding calculation of the bonds. This one that nicer to you, they tell you what's the par value. They say annual interest, fine, so it's annual, you don't have to do any conversion from annual to semi-annual. Investors will need to pay this. There's a tax amount, okay? So now we need to consider tax. So what do we have to do? So we know FD is 1,000, that's what they give us. PV is negative 950, right? Because money is going out of your pocket, you're paying. PMT, what's the coupon rate? So coupon rate is 8%, which is given here, 8% times 1,000. N is 15 years. CPT, compute. So what are we computing here? We're computing IY, right? Or we in Excel, we do it as the rate function. Right? Rate function. But wait, at the end of the day, we will have to consider tax. So once we get our answer, so our answer, let's say is I, right? I don't know what's the answer, but I, we need to take 1 minus 35%, right? So we need to do this. And we get the value something. So that, which is 5.6 here. Right. So yeah, this is again like a repeat, so I'll go a bit faster. Okay, so now we go to the last component of preferred stocks. So earlier we talked about return on equity or cost of equity. Cost of equity, remember we use two count methods. We use the dividend growth, we use CAPM, which we have talked about it previously. Then we went into detail about bonds, which is the cost of debt, and we use time value of money. And now we have the last component called preferred stocks. And how we calculate the cost of preferred stocks, we have to use the perpetuity formula. So this is perpetuity. So remember your dividend growth model is the growing perpetuity. This is just a perpetuity formula because preferred stocks usually just pay dividends forever and it's fixed, right? They pay dividends forever and it's fixed. So we can just use this formula here, which we learned in lecture 2. Perpetuity. All right, so we do have this question given here, where there was a preferred stock, relatively kind of direct. So they sell at this price, they pay dividend at this price. So we just take 2.5 divided by 6. All right. Okay, so those 3 components now that we talk about, cost of equity, cost of debt, and cost of preferred stocks, they are kind of like things that we have covered in the last 2 lectures. But now what is new here is this concept called weighted average cost of capital. So at the start of the lecture, we talk about cost of capital, right? And I say that there are 3 components that we need to consider. So now we're aggregating these components simply by using the weighted average of each component that's given here. Bear in mind that only for the cost of debt, which is RD, there is a tax shield that we get, or a tax deduction or benefit that we get here, which is 1 minus T. The rest for equity and preferred stock, we do not have it. So these are the weights. So weights meaning that we just need to add up the market value of the instrument, and we'll have an example to look at it. So weight is the percentage of the firm which is financed by each component. All right, so normally we try to use this idea of target weight, which is the weight for the company, like the targeted weight for the company of each component, whether it's stock or debt. But most of the time, because target weight is not available, we simply use market value. All right. Okay. So we do have a question here. Maybe we'll just do this question before we take a short break. So we have a stock price of this, and that the number of shares is 3 million. Okay. We have $25 million of preferred stock, 75 million of debt. All right. So let's calculate the weights first. So the weight of the stock. So stock, let's put S, and is 50 times 3 million, right? 3M, because this is the number of shares here, right? Just be careful with number of shares. All right, we get this something, right? We get something here. Preferred stock is given already by this, and debt is given by this. So we know that is $75 million. This is 150 million. Common shares. Sorry, just put here common shares, and preferred shares is $25 million, right? So once we have these three values, we can compute the WACC, which is the weighted average cost of capital. How do we do it? We do. Okay, so what's the aggregate of this first? 150, 175, 200, right? So this 200, the total is 200 million. Okay, so what do? We do for stocks is 150 divided by 200 times, they already give you, so this question is quite nice. They already give you a cost of equity, the cost of return, preferred stock, and the yield to maturity here, right? So it's, in a sense, it's a bit more direct. So you just times 14%. Now for preferred stocks, we have 25 divided by 200 times 9%. For debt, we have 75 divided by 200 times 10%, because we use yield to maturity, times, one more thing, we need to multiply by the tax rate of 1 minus 40. And the aggregate of this is your WACC. All right. Oh yeah, yeah, right. Yes, it's 250. Okay, yes. So yeah, everything is 250 here. Yeah. Yeah, thanks. Okay, so you know what? Maybe we take a break now. Let's just do like a 7 minutes break. We'll come back, at 8:10, 8:10, before we move on to the next example. Right. As usual, if there's any questions, feel free to type in the chat. And thanks for the correction. All right. Welcome back. Hope you have a short break. Okay, so we have been talking about this thing called WACC. Let's look at a comprehensive question, right? Wait, we have. Okay, so this is just the working. Now, in terms of factors of influencing WACC, we basically can understand these factors based on the decomposition of WACC, right? So things like the capital structure. So what capital structure means is that, what's the percentage of common shares? What's the percentage of, let's say, preferred stocks, or percentage of debt, right? So capital structure. What's the dividend policy? Because dividend policy can affect your preferred shares, they affect your common shares as well, right? Of course, the market conditions. What's the tax? Because for debt is tax deductible, or there is a tax shield. Okay. I will skip this question because the answer is given. All right. You can have a look at it. But I want to tackle this question instead. So let's look at what's this question about, and let's tackle this question together. Okay, so we are given two kinds of information: equity and debt information. Now, what do we have here? We have the number of stocks, as usual, 50 million number of stocks or number of shares, the price of the share. We are given beta, market risk premium. So I guess all this information we can imagine it as the cap M, right? Now, in terms of debt, we are given a various debt information, and all these can be used to calculate the time value of money, right? You can use time value of money for this. Okay, so you know what? I'm going to jump to the writing pad. So you have the question in front of you. So do refer to the question. I'll jump to the notepad so that we can discuss this. Okay, so how do we first solve the question? So we start by first determining the weight of each component, right? So let's determine the weight of a equity. So WE, so weight of equity, right? So you have the question in front of you. We know that it is 50 million times 80, right? $80 per share. Okay, divided by 50 times 80 plus. Okay, so at this point, I want to calculate what's the total value or total market value of the debt plus shares, right? So what is the value of debt should we use in this question? What's the value? Can anyone type it out? So plus, what's the amount? What's the value of the debt? And okay. Okay, so okay, why I like this question is super tricky. So unfortunately, it's not. It's actually 110. So go back to your question, right? Can you see that the question says current value is 1100. So you should use the current value. So that's the market value. So don't use the par value. This is very important. Don't use par value. Use the market value. So it's 1100. So you know what? To emphasize why is it 1100, let me just jump back to the slides. Can you see here? Current value and face value. Face value or the face value or par value. Remember, when we calculate weight, I always emphasize that you should use market value. And so because you're using market value, you should use the current value. So this is very important. So this question is very tricky. Okay. Hope everyone can put a big star in case it comes out in finals, just be very careful. Because of course, if you do this wrongly, it kind of like snowballs to your other question, right? Because if let's say you calculate your cost of capital wrongly, later we'll have some things that we need to do, that decisions that we need to make. And like say in the finals, it might be very difficult to give partial marks because you'll make the wrong decisions based on these numbers. All right. Okay, so I'll repeat again. The value of the debt is the current value of the price of the debt. So this 1100, and we should get 0.78 here. Now, this is the weight of equity. Weight of debt is 1 minus 0.78. So I like to use this 1 minus. You can redo it 1100 divided by the lump sum. You can do that as well. But I just take 1 minus because we know it's a pie, right? Or like a pizza. Okay. Now, in terms of return on equity, RE, we can use the CAPM model. So the risk-free rate is 5% plus the beta 1.15 times 9%. Yeah. Right. So we should get 5.35%. Now, in terms of doing the time value of money for the debt, now let's work out the number. So N, what is N? Maybe you can just type in the chat. N what's the number for this? No, not 15. Read the question. Yeah. Look, what is the coupon number? Oh, it's not coupon number. That's the coupon. Yeah, 30. So it's semi-annual. So so this again, I would say the calculation is not super difficult, but you just need to be very careful. Like the questions can be so sneaky, I like to call it. So it's 15 times 2 because it's semi-annual. Okay, PV. What's PV here in this case? So what's PV? We need FV. We also need PMT. No? Okay. So I'm sorry, but PV is the current. Remember PV is how much remember a bond is the piece of paper that you give to the not a piece of paper, the money that you give the company, and the company give you a piece of paper, right? So what's the money that you give the company at the present? So how much what's the PV in this case? Okay, but wait. Yes, okay. The last, I think Esther got it right. So it's negative. Very important is negative, because if you go and put positive, your IY, your rate for IY will be wrong, right? Because you need to consider the type of cash flow. Okay, so negative. Now, what is the FV here in this case? Anyone know what's the FV? 1K. Okay. What is the PMT? Okay, 90. Remember again, we need to divide it by 2. So this is very important again. Why? Because it's semi-annual. So it's 9% divided by 2 times 1,000. Okay, very important. Must divide by 2. So it's 45. So just be try to be very careful about this kind of question, because whether you need to multiply by 2, divide by 2, and all those, you need to be very careful, okay? Then you can get so that you can get the right answer. Now, if you plug all this in Excel using the rate formula, we should get the 3.93%. Now, question, is this answer of 3.93% the cost of debt? So the question, is it the cost of debt? Is 3.93 the cost of debt? Yes, no, maybe, or not too sure. No, okay, but then what is the cost of debt then? Okay. Yes, you have to times 60. Okay, maybe I'm not too sure, but I want to highlight this. So there's a lot of sneaky tricks. Like the question might look super simple, but it's a lot of things you need to be very careful. Now, this rate that you calculate is actually what? Semi-annual. Okay, I repeat, it's semi-annual. But your cost of debt is an annual rate, right? Similar to your cost of equities, is 1 year, right? But do you notice that whatever you have done here, so I'm going to highlight here, whatever you have done here, we have converted everything to semi-annual, right? Meaning what? For your cost of debt, we will need to multiply by 2. Everyone get it? So you need to multiply IY by 2. Okay? And so how do we calculate your WACC now? So WACC equals to the 0.78 times 5.35% plus 3.93% times 2 times 1 minus 40%, in the tax rate is 40%, times 0.22. So this is very important, this one. So I repeat again, why you multiply by 2? Because in your time value of money calculation, we have, remember, I always say you convert to a lowest base. Lowest base in this case is semi-annual. So everything in your calculation is semi-annual. But for WACC, what we're interested in is the annual rate. So we need to multiply the IY by 2. Okay, again, I repeat, you need to multiply the IY by 2. This is extremely important, right? Anyone needs me to repeat? You're not very sure. This is a very important concept. Or we're all good. So, typically that's how, in like, let's say your finals, question can be tough and tricky because it might seem very easy and then you're like, oh, you just do, but then actually there are a lot of small things that you need to be very careful about. Everyone's okay with this before we move on? Yeah, we're okay. We are comfortable with time value of money. Okay, so in exam, you can use Excel, right? We know you can use Excel. So same thing, just show the formula for Excel. All right. In case, for example, right, in case you like let's say you forgot to multiply by 2 or you forgot to divide by 2. So at least the marker can give you some partial marks. So do show the working in Excel. You can just do everything in Excel, just show the formulas in Excel, should be good. And you just do a screenshot. Okay. Now, so I want to put again, this looks like a very simple question, but be very careful with all this information here. This one. So I'll put a star on this example. Hopefully when you do a revision, try to look through this example again. Okay, so since we are good with this, let's think about the risk adjusted. So we have talked about WACC being the cost of capital for the firm, but it actually means the cost of capital for average of the firm. That means on average, the firm cost of capital is this, right? But if we are trying to make a decision on a project, and the project is not an average project, it can be a very risky project, maybe not so risky project, so it's quite different, right? The thing is, we cannot use the WACC to determine whether the project that we should accept or reject the project, okay? We need to use the risk-adjusted WACC to adjust to the riskiness of the project. And we'll have an example to show you this illustration, right? So you can read through all this. These are explanation, but it's what I'm trying to say. You need to adjust WACC. So this is an example that we can see here. So we are given the WACC, which is the average cost of capital for the firm at 15%, all right? Firm beta is 1. Now, this is, okay, so these are project specific. So let me just, this component here are project specific IRR and project beta. Okay, so what's IRR? IRR is internal rate of return, meaning what? That this project would return 14%. That means we'll give the company 14%. All right, and project beta. Project beta is the systematic risk of the project. Okay, so just looking at this green box that I have drawn here. For project A, by comparing the internal rate of return or the return of the project compared to the WACC, which is the average cost of capital of the firm, do we reject or accept project A? Okay, so by just comparing IRR and WACC for project A, do we accept or reject? Yeah, reject, because your, yes, it's lower than 15%, right? So your project is only giving you 14%, but your cost of capital, which is cost for the project, is 15%. So your project is only 14, but your cost is 15, so you should reject, right? Yeah, perfect. Now, the same sense, B, we should accept, right? Your project is giving you 16%, but your cost is only 15%, so you should accept. Now, but this is before considering the project-specific systematic risk, which is the project beta, which is what is shown here, project beta. Now, we have to use the CAPM model, to calculate the project-specific risk and compare it with the IRR. All right, so I repeat again, we will use the beta here to compute the project-specific riskiness and compare it with the IRR. We cannot use WACC because WACC is average. Now, this is going to tap onto your onto last lecture, and hopefully you can remember the SML line because it's important here, the concept of it especially. So in exam, they will not give you this. So this thing here is what I've written. In the exam, sometimes they can just give you a graph and then you need to do the calculation yourself. So what's important is how do we do a calculation, right? They can give you this graph with all the dotted points. So we need to know the specific points. And the best way to understand is what actually we mentioned last week. The CAPM is, anyone remember how do we derive the CAPM? The CAPM formula. So maybe I'll do like a recap on how we do this, because this is important. In the last lecture, we also talked about the SML line, and I think I could went in detail about it. But let's do like a quick recap on the SML line again. All right. So the SML line basically is this line here, right? Ignore this WACC one first. Okay. The SML line is the line where the securities are equitable, right? And there are 2 points, I think in the last lecture I mentioned 2 points that are important on the SML line. First, the risk-free rate. Risk-free rate meaning, so this graph is very nice to you. They tell you risk-free is 7%. But we know that when beta is 0, this point here is the risk-free. So we have already formulated RF risk-free as 7%. All right. We know another important point is market beta. Market beta being the beta of a diversified portfolio at 1 here. And so they tell you the market beta is at 15% return. So what does this mean? RM is 15%. So given that we have R risk-free and return on market, we can actually use the CAPM model, right? How do we use the CAPM model? CAPM model is 7% plus. Remember, now we're giving return on market, not market risk premium. Those are 2 different things. So now we are giving return on market. So we are doing what? 15% minus 7% times what is the beta? So the project beta in this case, let's just flip back and have a look, is project beta is 0.6. So let's put 0.6 here. And this should give you 11.8%. So what I'm trying to emphasize here is that sometimes the question can just give you a graph, and in the graph, they need you to determine this value here. So you need to understand the SML line to know important points. And the 2 important points are the risk-free and the market return, which is 15 and 7. So they will not tell you market return is this, risk-free is like how we saw they use T-bill, yield is this. So you know T-bill is risk-free, right? So they can give you the example of a graph like this and say, you know, you have various points, and so you need to derive the values from the points. All right, I'm going to, okay, so once we have calculated the project's risk-adjusted cost of capital, which is 11.8. Now, let's go compare. I'm going to flip back and compare. So this one, we have calculated 11.8. So now, comparing 11.8 with the return on the project. Now, should we accept or should we reject now? Correct. You should accept. Perfect. You should accept it because it is the project return is higher, right, than your project specific risk. All right. So there is, I'm just going to write the calculations for this 16.6%. hopefully you can go back and try to get the answer. Is 7 plus 1.2, 15% minus 7%. That's how we get the 16.6. Because the beta is 1.2. So pictorially in the graph, what's happening here is that your project, okay, so on your 11.8, what you calculated on equilibrium is 11.8, which is here. But then what you are, if you use WACC, you have your WACC is 15, which is here. So what does this mean? It means that you have actually, okay, so I'm just going to zoom in here. So if you use WACC says 15%, right? And your project is only for 14%. So because your project A is below, right? Is below your WACC, that's why you have rejected the project initially. But now when we did the correction, what happens is that actually the correct thing is here, and now your project is higher than your corrected risk. And so you have now accepted the project. So using the CAPM model to correct for the risk of the project gives you the right answer. Anyone has questions for this, like why, what we have done here? So if we are good, this is what is being shown here. All right. So naturally, if you notice, if we use WACC to reject or accept the project, what's happening is that we are accepting. So I'm just going to flip back to this. So when we use WACC to reject this project and accept this project, what we are doing is we're actually accepting projects with high beta. Can you see we are accepting this project? Oh, so many lines. Okay, can you see that we are accepting this project which has such a high beta here? This is the incorrect one when we're using WACC, which has a high beta, and means what? We are increasing the systematic risk on the firm, because the firm is accepting a lot of high beta project, and beta is systematic risk, right? And we are rejecting low beta project, which is low systematic risk. So overall, the risk profile of the firm is increasing. And so this is wrong. So what we must do is we adjust, like what we did for this, the CAPM model, so that we make the correct accepting and rejecting decision. So based on risk adjusted, this is the one that we should look at. We are accepting this project A and we are rejecting project B. Any questions regarding this idea of project rejection and acceptance? This is, I think, it's quite important. Important to understand. Okay, we are good. Now, in terms of, so that's one approach. So that's one approach of adjusting your risk to a project specific, because your WACC is the average, so we cannot use it for project. Another way to do it, so one approach is using that CAPM approach. Another way to do it is this idea of pure play approach, where we actually find one or more companies which produce the services that this project is specific about. So the project can be a new product line, like producing a new soap product line. So we find a company that is also producing similar kind of soap products, and we calculate the beta for the company, and we use the beta to input into our CAPM model to compute the risk-adjusted project specific risk. Right? So this is one approach called the pure play approach. Another approach we can think about is the subjective approach. So subjective approach meaning what? We simply just adjust the WACC by a different level, whether it's sorry, not WACC, we adjust the project specific risk based on the WACC. So whether it's higher WACC or lower than WACC. So the subjective approach can be something like this. You have like, this is WACC, the project is lower risk. So it's like there. So this is based on like historical data, let's just say. All right, so that is so much for WACC. Maybe I'll just pause for a while. Any questions, any doubts, or maybe any comments? You feel like this is super heavy or this is too finance? Okay. All right. So so that's all for WACC. We will kind of leave it as that. Now, what we're going to do is this idea of leverage. So we're going to move on to the like almost like a sub-component. And this is the part where we'll talk quite a bit on theory. And it can be a bit abstract, I would say. So bear with me, and I hope that if you have any doubts, do clarify them immediately, because it can be a bit abstract to understand. All right. So let's look at leverage now. So leverage means we're focusing on debt. All right. So just now WACC we talked about preferred shares, debt, common shares. Right now we're just focusing on debt and the effect of debt on the capital structure. So what is happening here now? What is happening here is that the capital structure we know is constitute debt and equity. And I mentioned earlier that debt has a shilling effect because of tax, right? Tax shilling effect. So the cost of debt is lower than the cost of equity. It means that naturally a company should want to finance more of their things in debt, right? And that's the case. So what the company can do is they call it capital restructuring. So capital restructuring is an important concept where the company do not change the total amount of asset. So your total asset TA remains fixed. TA total asset is fixed. What they are doing is, let's say if they want to increase leverage, all right, increase leverage, they can issue the debt, right, issue the bond and repurchase shares. So because you are issuing debt and you repurchase the shares, there is no increase in total asset. You are just changing the structure of your company. Increase debt, reduce equity. We can do a deleveraging or decrease in leverage where we issue the shares, right? When we issue shares, we get money, right? And we retire debt, so we reduce the debt. So that's how we can work. We can either do increase leverage or decrease leverage. But what's important is that when we do capital restructuring, the total number of assets here remains unchanged. All right. So this brings us back to the goal of financial managers. So this actually relates a bit to your TMA. Later we'll go through it. The goal is to maximize stockholder wealth, right? And I think your TMA, they say share price. So I hope if you do remember your TMA, you should mention how maximizing share price is actually the goal of financial management or financial managers, and they should do it. So it's actually a long-term goal, right? So that relates a bit to the TMA, but we'll go through in a bit. So this relates back to the goal of financial managers, where we want to maximize stockholder wealth or share price or shareholder wealth. And how do we do it? Remember, we have mentioned about WACC, weighted average cost of capital, and we want to always reduce this, right? We reduce this, and we, in the process, increase the firm value. So because we have learned WACC now, we are trying to minimize WACC. And how do we minimize it? We use tax shield. We use a tax shield because that gives us a tax shield. So we can use tax shield to do it. Now, but the issue with taking on more debt is that it increases our standard deviation, or it increase our total risk. And we have example to show you why it increase total risk. So when you increase standard deviation of our returns, means that increase the dispersion of our returns. So that amplifies the variation, or what I like to think of it is standard deviation of both the EPS and ROE. And in this example, we're going to ignore tax, so we're not going to consider tax shield and all those things. We just look at the simple example of how it affects or how it increases the variation. All right, so we have two capital structure here. So the current one is purely equity. Can we see? Current is pure equity, no debt, total assets 8 million. Now, the second proposed is 4 million equity, 4 million debt. So debt to equity split, but total is also to 8,000, right? So it's a we call it leveraging, increased leverage, but it's a capital restructuring, right? So we are having a capital restructuring here. Now, the thing is, of course, we look lesser shares, the number of outstanding is lesser. I want to take note of this. Okay. And let's do some calculations now. So this table looks a bit busy, a bit messy, but don't worry, just focus on this. So this is the no debt structure, right? No debt here. So at no debt, we are trying now to calculate the ROE, we are trying to calculate the EPS. So for no debt ROE, we are given by this. So how do we calculate 6.25? We just take, let's see, what's our return? Our return is okay, 500, right? Net income 500. Okay, so it's just 500 divided, or 500K divided by equity amount. What's the amount? Equity is 8 million, right? So we divide by 8 million here. So 800K. So that's how we get the ROE, the EPS. So EPS is calculated by earnings per share. So earnings is 500K. What's the number of shares? We have 400 shares, right? The 400K shares. Let me see. Yeah, 400 here. So what we're doing here now is we are calculating the ROE and EPS for various states of recession, expected, which is normal, and expansion phase. Of course, recession, you have lesser EBIT, which is the earnings. Your expansion, you have the most earnings, right? Most earnings here. So after we have done the calculation, let me just erase this. The figures in the red box gives you the EPS and ROE based on the various states. Now, the thing is, if we are taking debt, so this is the first, so propose is we take half debt, right? Which is this. Now, if we are taking debt, what is happening now? We have to pay interest on the debt, right? And the interest is regardless whether we are in a recession, expansion, or expected phase. We always have to pay this fixed amount. And because of this fixed debt that we have to pay, it will impact our variability or dispersion of ROE. Okay, let's look at recession. Can we see that in the recession phase, if there's no debt, our ROE is 6.25. But in a recession, if we have debt, is 2.5, so much lower, right? Our EPS, no debt, is 1.25, but our EPS with debt is 0.5. Now, I'm going to compare it with our expansion phase. you notice that we know that our expenditure is 18.75, but if we take that, we expend so much more. Can you see that we are expending 27.50 for ROE? So what is happening here? I'm just going to the next slide and to show you. So with that, so the proposed is with that. So with that, our variability for ROE and EPS has increased dramatically compared to no debt. And it shows that debt is good when the economy is doing well. When the economy is not doing well, debt is bad. Everyone's okay with this concept of debt? So we are understanding the effect of debt. So what's important is that whenever you make a comment on debt in your exam, in your questions, when you make comments on debt, you need to be very careful. What kind of phase is the company in? What kind of economy the company is in? Are you talking about a company in a growth economy? Then you should think about more debt, right? In a growth economy. But if you're thinking about a company in a recession economy, then you shouldn't recommend more debt. So you need to be very careful whenever you answer questions for debt, because debt has a dual effect depending on the economy. All right. Okay, so we can calculate break-even EBIT. So break-even EBIT, we just equate both of the EPS together, because you know the earnings per share should be equal. So earnings, right? So EBIT divided by total number. This one is without debt, and then now we have the EBIT minus the interest. This is the interest amount, divided by lesser earnings per share, because the number of shares is lesser, right? 200K only. So we equate this and we can find the break-even EBIT here. So what does this break-even EBIT means? I like to use the graph on the next page to explain. So the break-even EBIT means that at this point here of 800K, there is no difference whether you are taking debt or no debt. All right. Now, if your EBIT is above 800K here, you should take debt. Debt is good. I want to take debt. Can you see that this graph here is above the no debt graph? So the debt graph is above the no debt graph. So yes, you should take debt. Now, if your EBIT, you forecast your EBIT is less than 800K, no debt. So debt is bad. You don't want debt now, because the debt will pull down your earnings per share. Right. So we have a discussion question here. I'll just go through the first part of the discussion question. So let's just look at part A and part C, right? Because if you do A, B is the same. All right. So we have two plans. So under plan 1, Carl would have 400K shares outstanding. Under plan 2, Carl will only have 260K shares and this amount of debt. All right, we are given that interest on debt is this amount. We are not going to consider tax shielding, which makes things a lot simpler. And we know that EBIT is this amount. So what is the EPS? So let's look at plan 1 first. So we are doing part A at plan 1. So plan 1, we know that there is no debt, right? We just simply use all equity. So we just take the earnings, which is 1.3 million, divided by 400 shares. Okay. Now, under plan 2, we know that now we have how much of, let's just flip back. We only have 260K shares and we have some debt. So in terms of the interest on debt, we know it's 10%. So we just take 10% times the total amount of debt, which is this. So our earnings has decreased now. Can you see our earnings has reduced to 698K. Now, in terms of number of shares, of course, it's lesser. So our EPS is this. So in plan one, it seems like leverage is working against the company. Can you see that with leverage, the EPS is lesser than no leverage here? So hopefully you are trying to do this question. We do this question with part B, given the EBIT of this, and you realize that actually leverage is working for the company in that sense. And the question now is, what is the break even, which is what we like to always calculate. What is the break even, right? So at what point does that works for you, and at what point that works against you? So the calculation is the same. We let EBIT be X. We let the EBIT be X here, and then we plug in the number of shares in plan one, where we have 400 shares, 400K shares. And for plan two, we have interest amount, right? Interest of 10% here. And then number of shares is lesser. And so we are able to calculate X, which is the break-even EBIT, right? The EBIT here. So conclusion from the discussion so far is that increased the variability of our ROE and EPS. And the thing is, it's beneficial if our EPS, our EBIT is high, is more beneficial to take that. Now, we know that the leverage of the firm affects the firm value and WACC. The question now is, does this restrict only the risk for an investor point of view? Can we actually create our own leverage? Because, for example, a company's leverage is based on its strategy and everything, right? But like as an investor, like for myself, can I actually influence the company's leverage? And the answer is probably no. I cannot force the company to change their structure, capital structure, right? But what I can do is I can actually change my own capital structure. And this is the part where we'll talk about homemade leverage. So I'm going to make my own leverage or homemade unleverage. Right? So this, maybe I think we should pause here. We take a break and then we continue on this homemade leverage. So homemade leverage is as if we are changing our own capital structure because we cannot change the company's capital structure to, in this sense, leverage or unleverage our investments. All right, so let's take a break. It's a bit heavy, I would say. Let's take a break. We'll come back, let's say, at 9:05 or something, and then we'll continue. As usual, any questions, feel free to chat. All right, welcome back. How's everyone's holding up? It's a bit heavy, I would say. This lecture is a bit heavy. Everyone still okay? Still surviving? Yeah, okay. Yeah, maybe just bear with me a little while more. Let's try to push on. Let's look at this thing called homemade leverage, right? So just before the break, we talked about the concept that you know what, let's say we want to unleverage or we want to take on more leverage, but we cannot force the company to do that, right? As an investor, we can't. So we can actually do homemade leverage or homemade unleverage to adjust the capital structure, and that's what we'll see how we do it. In terms of leveraging, what we do is we borrow money and we buy more shares, right? When we borrow money, our debt. So now we are taking a more investor point of view. So imagine now you are an investor. You need to consider your investment in the company and your own leverage. So we are stepping out of the company now. Previously, we are just looking in the company. Now we're taking investor point of view. So from investor point of view, how do we make homemade leverage? We borrow money and we buy more shares, right? So we are increasing our leverage. How we do homemade unleverage? We sell some shares and we lend money out. So in both sense, can we see that our capital structure, the total capital structure does not change. So our total asset does not change. Total asset meaning our own personal asset as an investor in terms of our investments. All right. So I repeat again, we are taking a step out and considering not only the company, but our own money as well. Okay. So this just I just put in this slide as a reminder. So it's exactly the same. Not too important. Now, this slide is the slide that is important that I want to focus on. So basically, we're riding on the case that we saw earlier, right? The case meaning the Trans Am case that we talked about in detail. Now, I want to consider homemade leverage. Okay, so imagine our current capital structure is this: the investor buy $2,000 worth of shares, which is 100 shares. All right, and in terms of so this is not proposed, this is current. Okay, there is a small typo here. And this is supposed to be proposed. Okay, so we know that based on our previous calculation, EPS is during a recession is 0.5, expected is this, expansion is 5.5. We have calculated that earlier. So flip back to the last, let me just quickly show you this one. Can you see this? So we have calculated all this here already. So we're just using the same data. And if we buy 100 shares, we know the payoff will be given by this, right? The payoff. So we have 100 shares, we just multiply the payoff with this. Now, the thing is, what if we want to do homemade leverage? So remember, if we are increasing leverage, what do? We borrow, we take the money, borrow from the bank, let's say, borrow 2K at this amount here, all right? And we use the 2K to purchase, because we have 2K now, we purchase 200 shares at $20 per share. Okay, so once we purchase these shares, what is our payoff structure now in terms of PS? So with the leverage, we calculated, so this part here, so we calculated, we take the EPS of 1.25 multiplied by 200 shares, and we minus away the interest that we have to pay for the debt, and we get $50. We do this for the expected and the expansion phase as well. And what do we notice? We notice that the payoff structure is exactly the same, 50 and this. Can you see? And how do you get the 1.25, 0.25? Let me just flip back to the slides. That's why I put this slide for reminder. Is this? Can you see that? Can you see this? So what is happening here? So what's happening here is that, let's say the company, okay, so I'm going back to this slide. So let's say the company does not have debt. That's why the structure is given by all this. If it does not have debt, we can create our own debt by borrowing. And so we have created a proposed homemade leverage. But let's say the company already have debt. Then we don't want any more debt. We just remain as this. So we just buy the stocks. So in this sense, right, by creating the debt, our payoff structure now becomes exactly the same, whether with or without debt, because we have created homemade debt. In this sense, this we have created homemade debt. All right. Everyone understand this concept of homemade debt? Okay, so now we tackle the theory part. So I want to put a caveat on this theory. I would say that so far I have not seen any questions in exam or in the GBA testing this concept, but it's actually part of the syllabus. So I feel that we should still go through it, but I've not seen any questions. So it might actually come out, it might not come out. But yeah, we will do go through it because it's part of the syllabus. And this concept is called the M&M capital structure theory. So this is a theory, right? So it might not be, it's not like real life kind of, you might not see in real life, but it's a theory that is there. Okay, so the M&M theory has two propositions and three cases. Okay, so there are three different cases that we'll look at. Each case we have two propositions, and proposition one, prop one, always refers to value of the firm. Prop two always refers to WACC. So for every case, we'll tackle prop one, prop two, prop one, prop two. All right. And when we think about value of the firm, we need to focus on the cash flow of the firm. Okay. So whatever factors that affect the cash flow will affect our value of the firm. So if there is a reduced cash flow, the value of the firm decrease. All right. So that's what we're going to study. Now, in terms of the case, I mentioned there are three cases. So we'll use the case one as no tax and no bankruptcy costs. Case two is where there's tax, but no bankruptcy costs. And case three is where there's tax and bankruptcy costs. This is, I guess, the most real life example. But remember, all these are theories. So that's why we can make some assumptions that, oh, there's no tax and all. Of course, in real life, there's no such thing, but it's just a theory. Okay. And the idea is that we want to understand how does the assumption of, let's say, case one, when there's no tax and no bankruptcy costs, affect the type of capital structure the company will employ based on two propositions. Number one, the value of the firm, and number two, the WACC. Okay, so let's look at case one, the perfect capital market. In a sense, it's called a perfect capital market. And there are two propositions, remember? So case one is when there is no tax and no bankruptcy costs. The first proposition is that the value of the firm is not affected by the change in capital structure because the cash flow does not change and therefore the value does not change. Okay. So this is the first proposition. Proposition two, which is about WACC, says that the WACC of the firm is not affected by capital structure. Okay, so these are the two propositions. We'll look in detail now. So we'll see why the propositions are being posted as such. Again, I want to repeat that if you have any questions, do stop me because this is quite theoretical. It can be a bit difficult to understand, but it's important to understand this. Okay. All right, so let's go into detail. So we're still on case one, where it's a perfect capital market. And let me try to explain to you how does proposition one works. So proposition one says that the value of the firm is not affected by any change in capital structure. So how do you imagine this? Is that since there is no bankruptcy cost and there is no tax, right? We do not get any benefit from, let's say, taking on more debt. Remember earlier we said that debt has a tax shield. We don't get this benefit, right? And by taking more debt, we do not expose the firm to more risk as well in terms of bankruptcy, right? Because in case one, it's a perfect capital market. Because of this, there is no difference between taking more debt and less debt. And it is almost like this pie or like a pizza, where if we take 40% stock and 40% bonds, or 60% stock, 40% bonds, there is no difference for us because there is no additional benefit or cost affecting the value of the firm. And because of that, this means that in case one, where there's no debt, there is no tax and no bankruptcy costs, the value of the firm is unaffected by capital structure. It does not, the firm doesn't care about capital structure. Is everyone okay with this? On proposition one, case one? Okay, so now let's look at case one, proposition two. So proposition two is about WACC, remember? And the proposition says that it does not affect WACC under a perfect capital market. So this has a bit of calculations now. So I want to, there's a lot of explanation here, but don't worry. Let's look at this component. So I'll try to derive this formula for you to explain to you, right? This concept. Let me just pull back to the this component here. So again, I want to highlight that knowing how to derive the formula is not important, but you need to understand the formula well. Okay. So we know that WACC equals to the equity divided by V. So V is the total value of the firm, all right? Multiplied by RE, which is the return on equity. Debt divided by V, which is total value of the firm, multiplied by RD, all right? And there is no tax, right? So remember previously WACC, we have 1 minus tax, but in this case, we are in a perfect capital market, do not consider tax. So WACC is just like this. Now, I want to let WACC be this thing called RA, just for notation, RA. And you'll see why in a bit. Okay, so I'll let WACC be RA. And what am I trying to do here? I want to equate RE, right? So RE equals to RA minus DVRD. Everyone can get this? Basically, I'm just shifting the RE here to, I want to equate RE. So how do I remove the EV? So how do I remove this component here? I basically just multiply VE to everybody, right? So what does this mean? VE here, RA minus, VE dV RD. So I'm multiplying VE to every term. So it removes away the EV, right? So what can I do? V and V I cancel off. We know V, okay, let me just pinch it here. We know V, V is the value of the firm. V is equals to D plus E, right? Everyone also okay with this? So now V equals to D plus E because the value of the firm is equals to debt plus equity. So what's happening here? So we have D, E, R, A. So I'm just multiplying E now. So so E plus E divided by E is 1. So it's RA minus D, E, R, D. All right? Everyone's okay with this formulation? And can I see that? I can see that DE, DE, right? So I want to put all the DE together. So RA plus DE RA minus RD. Okay. So RE equals to this. All right. So what have I done here now? I have actually equated RE, which is return on equity, equals to this thing called RA plus D divided by E bracket RA minus RD. So what did I find out? Actually, this component here is WACC, right? I say WACC equals to RA. And WACC is given by the idea of business risk, biz risk, right? So what is the risk on the business? Because it's the cost of the debt, or also cost of capital of the business. All right. And this component here is actually given by fin risk, financial risk, because we are talking about the debt structure, right? RA is the WACC minus the RD, which is the return, cost of debt. So this is the fin risk. So this is biz risk, fin risk. So I have now two separate components of biz risk and fin risk. All right, so I'm going to jump back to the slides. So I have actually done the derivation here, right, to give you biz risk and fin risk. And let me explain what is biz risk and fin risk. So business risk is the risk associated with running the business, operating the business, right? And it relates to your WACC, where you have your sales, operations. So they are just basically risk associated with the business. Fin risk, on the other hand, is financial risk. And this risk increases with more debt. So the more debt you take on, the more financial risk you add. So the risk of bankruptcy, the risk of unable to pay your interest. So these are fin risk. All right. So more debt means more fin risk. So what's happening now? So once I decompose the formula, I'm going to run back to this slide here, which is very busy, very messy slide. But what's happening here is that when, maybe I shouldn't use this slide. I should use this slide here. Okay, so what is happening here? So when debt to equity ratio increase, okay, so when debt to equity ratio increase, this one increase, my fin risk increase, right? When I take on more debt, my fin risk will increase. Now, when fin risk increase, my RE will increase, right? So RE will increase. Now, actually, I want to go back to here. This, okay, I'll use this example, easier to explain here. So again, I repeat, when debt to equity increase, so when debt to equity increase here, so when this increase, RE will increase. So what happens in terms of, okay, so if I focus now on the WACC component here, what happens here? So when debt to equity increase, RE increase, this component RE will increase, right? And E divided by V would decrease, right? Because now you're taking more debt, there's less equity. And your D to V will increase. Your RD remains the same. So because of these various increase and decrease, where your RE increase, your E divided by V decrease, it actually offset each other. And when you offset each other, your WACC remains the same. So this is a very important part. Everyone's okay with this concept. Why your WACC remains the same? Because we have decomposed both into bis risk and fin risk. And through the concept of bis risk and fin risk, we can show that when we take on more debt, your fin risk increase, your RE increase, but your increase in RE is offset by the decrease in percentage of shares, percentage of common shares compared to the increase in percentage of debt in the company, which is shown by WACC here. So basically, whatever I've explained is actually written down in this very messy and very busy looking slide by saying exactly what I'm saying. So can you see that when we have a change in capital structure, the cost of equity, there'll be a change in RE, right? So WACC remains the same. In this sense, why? Because when D divided by V, meaning the amount of debt increase, E divided by V decrease, RE becomes bigger due to more debt because of fin risk, and RA remains unchanged, and therefore WACC remains the same. So this is in the case of case 1, perfect capital market, an explanation of how proposition 2 affects your WACC, where there's actually no effect on WACC. Okay, so this is a bit complex, but don't worry, after this lesson, look through the slides again. It will be clearer. All right, read through the slides again. If needed, rewatch the recording. And so pictorially, if we look at this case, what it means is that, can you see, as debt to equity increase, your RE increase, right? We already show that in the decomposition of fin risk, right? So we know that increased debt increase RE. We also know that RD remains the same. And because of the balancing effect of increase in RE and the reduction in percentage of shares in the capital structure, your WACC remains the same, remains constant. And this is the proposition 2 in a perfect capital market. All right. So I'll not go through this question. So do have a look at this question here. All right. This is just trying to explain or trying to show you that WACC remains unchanged. You can have a look at it. But I want to go through this question because this one has there's no answer there. So let me go through this question with you. So in this example, we're using case 1, proposition 2. All right, so they say WACC of a firm is 16%, cost of debt is 10%. Suppose the percentage of debt is 45%. What is the cost of equity? Now, usually in such questions, they will specify what proposition and what case you are using. So this has already specified that you are using case 1, proposition 2. And under case 1, we know that there is no debt, no tax, and no bankruptcy costs. And so because of that, we know that the WACC equals to percentage of debt is 45%, 45% multiplied by 10% cost of debt plus the cost of equity, right? So amount of equity is 55% equity, right? Because 45% is debt, 55% is equity, multiplied by RE, right? Which is what we're trying to find. And we know that WACC is 16%. So we can equate blah, 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 RE, and we can find that RE is equals to 20.9%. Right? This is just an equation. We just equate this. All right. So what's important is that we are using a WACC formula without tax, and because this is under the case 1. So you just need to read the question carefully. If they propose using case 1 of M&M theory, we shouldn't include tax. Okay. Now, part 2, suppose that the cost of equity is 25%. What is the debt to equity ratio? And what's the percentage of debt? Okay, so now this is a part 2 of the question. Again, we know that WACC is 16%. We know that cost of debt is 10%. So part 1 and part 2 is not connected. So this component is applied for both parts of the question, but this part here is not. It's not applicable for part 2. We want to find what's the debt to equity ratio. So we know weight of the debt is WD plus a cost of equity is 25%. We know that the weight of equity is 1 minus WD. Okay. Once we get this equation, let's you can do the algebra and shift the WD and everything. What we should get is WD is 60%. Okay. You can try to get the answer 60% at home after this lecture or tomorrow or what. And so we know WD is 60%. Now, the question is, what is debt to equity, right? So debt to equity is, what's the debt? Debt is 60%. What's the equity amount? It is 1 minus 60%, right? 1 minus 60%, which is 60% divided by 40%, which is equals to 1.5. All right. Okay. So unfortunately, we still have to push some more. I know it's quite heavy, but let's carry on to case 2. And trust me, case 3 is the simplest to understand. So now case 2 is the concept of the imperfect capital market, where there's corporate tax but no bankruptcy costs. Okay, so there's tax now but no bankruptcy costs. And again, we need to look at 2 components: proposition 1, where we look at firm value, and proposition 2, where we look at WACC. And we need to decompose the effect of having corporate tax but no bankruptcy costs. So recall now that I've mentioned a few times already, recall that when we have taxes, that actually provides a tax shield. I've spoken about this idea of tax shield a few times now. And so the tax shield, what it does, it increases the cash flow of the firm with tax shield. And with the increase in cash flow to the firm, the value of the firm increase, that we mentioned earlier, that firm value equals to what is the cash flow. So let's try to now derive this relationship, right? So we need to use a bit of mathematics to derive it. Okay, so we are given two types of firm: unlevered firm and a levered firm. So unlevered means there's no debt. Levered means there's some debt. All right. We are given these values here. Notice that your cash flow is basically your net income here plus 80, right? That's how we get 724. Okay, so this is a levered firm. But this is just the example. Now let's do some calculations to prove that the value of the firm increases, right? Because now proposition 1 is about value of the firm. And let's look at the cash flows. So we have talked about the concept of tax shield, where taxes. So let's just see, right? When there's an interest, of 8%, we have a debt of 1K, we have to pay an interest of $80, right? $80 of interest. Now, what's happening here? This $80 of interest will be taxed at what? How many percent? 30%. So we are actually paying, there is an annual tax shield of $24 that we would receive. Let me just flip back to the previous slide here to make it a bit more, to cement the concept. Can you see that here and here? Do you notice something? There is actually really a tax shield that's happening. Can you see the levered firm is getting more cash flows than the unlevered firm with no debt? So unlevered firm is getting 700 of cash flow. Your levered firm is getting $24 more. And this is supported by my annual tax shield calculation. So it's actually really, there is a tax shield because basically you're using the money to pay interest, and therefore when you pay interest, the amount of tax you pay is lesser. So there's a shielding effect that you get. All right. So the idea of a tax shield, it is almost like a perpetuity, right? So if we are going to assume a perpetuity now, so we're going back, we're going to tap on your lecture 2 concepts. If we're going to assume a perpetuity, what happens? So we just take annual tax shield divided by your return on debt, right? And you know your annual tax shield is 24. Your return on debt is 8%. Just take 24 divided by 8, and we should get 300. So this is your value of your tax shield, is $300. But we also know that how do we calculate annual interest tax shield is we take D times RD. So D times RD times T, which is tax, right? Tax rate. And we divide by RD. So what can we do? We can actually cancel RD and RD. And what do we get? We just take D times tax. So what is D? So D is 1,000, right? D is 1,000 times, what's the tax rate? 30%. And we simply get 300. So we can just take this as the formula to calculate the present value of your tax shield. I want to pause here. I just want to do a quick check. Is everyone following what I've been explaining about the proposition? So we are still on proposition 1, case 2. Everyone's okay with it? Yeah? Okay, good. Okay. All right, so we are not done yet. So we have calculated what is the benefit or present value of our tax shield. Now, the thing is, we know that a firm, the levered firm value, the value of a levered firm, meaning that with debt, is equals to the value of unlevered firm plus the value of the tax shield, right? So levered firm means that the value of the firm with debt equals to the value of firm without debt, unlevered firm plus the value of the tax shield. So how do we calculate the value of an unlevered firm? So if we use a very simple perpetuity again, so we're using perpetuity, we can calculate what is the value of unlevered firm VU, right? And how do we calculate VU? We just take the debt, EBIT, multiply by the tax, because now that we are considering tax, because in imperfect market. But we need to use the RU being the cost of capital of unlevered firm. So once we calculate what is VU, so once we have VU here, we know that VL, which is the levered firm, is equals to unlevered firm plus the value of the tax shield, where we can derive the formula of tax shield as D times TC, right? D times TC, which is that times the amount. Okay. What is interesting to take note is that, can you see that as your D increases, when D increases, the value of VL increases, right? So what does this mean? It means, this is a very important concept here. It means that under case 2, proposition 1, the more debt you take, the value of your firm increases over time. So you should take 100% debt. That is the conclusion of proposition 2, case 2. I have a pictorial version to explain to you in this graph. So this is the value of the unlevered firm where there's no debt. So the value remains constant. Now, the value, the increase, this light blue here is the increase in value as you take on more and more debt, right? And this is the tax shield that we are getting here, T times D. So you see that the value of the firm, of a levered firm, VL, increases as you take on more debt. So conclusion is that we should take on as much debt as possible. There is a question here that we have to tackle. So now we need to consider two kinds of cost of capital, the levered firm cost of capital and the unlevered firm cost of capital. So what is the value of the unlevered firm? So the value of the unlevered firm, we know that EBIT is this, we have a tax rate of this, we have the unlevered firm cost of capital. So what is the value? We can use the idea of a perpetuity. So 1,000, 1 minus 30% divided by 10%, right? So this we should give you 7,000, which is the value of the unlevered firm. Now, what is the value of the levered firm? So remember, levered firm, we just need to take the unlevered firm of 7,000 plus the tax shield that we get, so which is debt times tax rate, 30%. So this should give us the value of a levered firm. What is the value of equity? So equity is the value of the levered firm, which is 7,300 minus the value of the debt, which is here, 1,000. Okay, so questions regarding M&M can look a bit simple, but you really need to understand the concepts behind it. If not, you'll be plugging in random numbers, what is the levered cost of capital and everything. So I highly suggest that you, after the lecture, read through the concepts. The questions can be very simple, like you see the calculations are simple, just that you need to really understand concepts so that you know what formulas to use, because there are a lot of different formulas. Okay, so so far we have proved in case 2, proposition 1, that the value of the firm is dependent on debt. So more debt we take, the higher the value. Now, we do need to tackle proposition 2, which talk about the WACC and how WACC is being affected. In this sense, we first will have to derive the RE formula. Remember, I'm just going to flip back to this part. Remember, we derived, recall that we derived this, the RE. So we're going to do the same thing for case 2, but I'm not going to show you the derivation of how we do it, right? So, but we can take the formula as RE equals to RU, which is the unlevered firm, equals to RU unlevered minus RD. So can you see that this portion here looks like your fin risk, right? This is your fin risk. This is like your bis risk. So when we increase debt to equity, when D to E increase, fin risk will increase, right? Fin risk will increase. And because you have our debt component here, what happens to our WACC? As we take on more debt, our WACC will decrease because we are getting a tax shield effect, even though we are taking on more fin risk. So here there is a example of how we're going to apply proposition 2 in, let's say, a test question. So we are given, again, the EBIT, we give tax rate, and basically almost the same stuff. Now we are using proposition 2 to calculate the cost of equity. So how do we calculate cost of equity here? We know that the unlevered firm cost of capital is 10%, which is given here, plus 10% minus cost of debt 8%. What is our debt amount? Debt to equity, 1,000 divided by 6,300, 1 minus 30%. So I'm using basically this formula here to get this answer, 10.22. Cost of capital. So cost of capital is WACC. We just use the normal WACC formula divided by 7,300. I hope everyone knows how to get 7,300. We just add these two amounts times 10.22, which is cost of equity. Now, what's the cost of debt? The debt is 1,000 divided by 7,300. Cost of debt is 8%. There's a tax of 30%. And we should get our cost of capital. So again, I'll repeat that the M&M theory can be a bit complex, but calculations are simple. So the important thing is that you need to know which formula to use. So understanding the theory is important. Yeah. Okay. So in a graph, pictorially, what is happening here? We see that as RD, debt to equity, increase, all right, our RE increases. Hence, because there is a tax component now, right? There's this tax here. We are getting a tax shielding effect, and therefore our WACC would decrease, right? So the more debt we take, the better, because our WACC will keep on decreasing due to the tax shield that we're getting. Okay, last but not least, we have to consider case 3. And case 3 is the part where it has bankruptcy costs plus tax. So we have everything now. And this is like the most real life example. And when we have bankruptcy costs, what happens? When we take on more debt, our probability of bankruptcy increase. So remember earlier in case 2, we say that when we take on more debt, we have tax shield, right? In the same sense, because we have tax here, we will have tax shielding and bankruptcy cost. So tax shield would improve our value. Bankruptcy cost, of course, being a risk, would decrease our value. So there is almost an offsetting mechanism that is happening here, where we have both bankruptcy cost and tax, where it's going in the opposite direction. All right, I'll not go through what is bankruptcy cost. Just have a look at it. What's the direct cost and all those indirect bankruptcy costs. You have a look at it. All right. So what I'm interested in to show you is this. This is case 1. Yeah, case 1. Case 3. Case 3, proposition 1. So prop 1. So prop 1. Remember, prop 1 is about value of the firm. So based on, so we go back to the tax shield. So based on tax shield, we know our value of the firm increases as when it's a levered firm, right? When it's more levered, our firm value increases because of the tax shield. But at the same time, now we have the present value of the debt, which, sorry, not present value. We have the bankruptcy cost that will force our value of the firm to decrease. Because remember, as we take on more debt, the chances of bankruptcy increases because we cannot pay our interest, and therefore the value of the firm decreases. And therefore, the optimum amount of debt is when there is a good balance between the benefits of tax shield and the benefits of the debt without taking excessive amount of debt. So this is the optimal capital structure in case 3, where we must consider bankruptcy costs and we have to consider tax. Now, what is the optimal structure for WACC? Remember, so now WACC, this is under the Prop 2, Proposition 2, where we are interested in WACC. So what does this say? So remember, the tax shield decrease WACC, right? And decrease WACC is good for us because it's lower cost of capital. So tax shield decreases WACC, but again, the bankruptcy cost would increase WACC because of the risk of bankruptcy. And therefore, the optimal structure, again, is a balance between the debt to the equity. So in a sense, case 3 is quite good because there's not much calculation. You just look at graphs and understand the concept. But case 1 and case 2 are a bit more calculation heavy. So that's an overview conclusion. In case 1, when there's no tax and no bankruptcy costs, there's no optimal capital structure. Yeah, because we are indifferent, we don't care, right? Whether it's nothing debt or equity. Now, in case 2, when we only consider tax but no bankruptcy costs, we just want 100% debt. All right, 100% debt, because debt provides us the tax shield effect, because we are only considering corporate tax. Now, in case 3, where we consider bankruptcy and tax, now there is an optimal level, right? There is a balancing act that we have to do. Okay, there is one last example that I'd like to highlight to you here. We have this corporation, we have expected EBIT of this for every year, forever. So we know this is a perpetuity. The company currently has no debt, and the cost of equity is this, corporate tax is this, right? What is the current value of the firm? So because we know that the EBIT is this, we can consider it as a perpetuity. So 19,750, 1 minus tax, because this is a case 2 example, right? Because we're considering tax. So it's a case 2 example. Divided by the cost of equity of 15%. So this should give us our value of the firm. Now, suppose the company borrow at 10%. If the corporate tax is 35%, what will be the value of firm if the company takes on debt equals to 50% of the unlevered value? Oh, wow, okay. What if it takes on debt equals to 100% of the levered value? So now we're in a case 2 position. So let's do the first part first, 50% of unlevered value. So value of the levered firm, value of levered firm is the value of unlevered firm, right? Unlevered firm plus the tax shield. So what's the value of levered firm? 85583, which is what we calculated here. Plus, what is the value of the tax shield? 85583 divided by 2, right? Because we're taking 50% debt times what's the shilling effect that we are getting here? 35%. So this will give us this. And remember, for case 2, the optimal structure for the capital structure for the firm is 100% debt. So 100% debt meaning what? So let's calculate at 100% debt, what will happen? So at 100% debt, value of a levered firm equals to 85583 plus 85583 times 35%, because we are taking full amount of debt here. And this should give us this. So in this example, it proves that taking more debt under a case 2 example will increase the value of our levered firm, simply because of the tax shield that we have experienced here and the tax shield that's experienced here. And why we divide by 2 here? Because 50%. But in this case, we are taking 100% debt. All right. I know it's a bit heavy, especially this last part on M&M theory. So I highly recommend for you to read through. The calculations, as you see, is not difficult, but you need to be very clear, what case are we talking about, right? I know it's only 4 minutes before 10. It's really 4 minutes before 10. Let's just take a quick 1 minute break. Those that can stay a little longer, we'll go through a TMA. If not, you can just watch the recording, right? So it's not mandatory because I know it's almost time, right? Let's just take a quick 1 minute break. All right. Yeah, I know it's quite a heavy class today. Like I say, so for those that came a little later, about the TMA, the results will be out at 12 midnight today. So I guess in 2 hours time, because there is a so-called like a cut-off, like a date that we can release the results. So it's 12 midnight today. So unfortunately, you cannot see your paper at the moment. But overall, I think the class did, like I say, very well. And I'd like to actually highlight that, like especially for question 1, like I think maybe the case that I gave kind of actually helped so that you come and able to explain the concepts in terms of analyzing the financial statement. Okay, so let's just look at the questions. I'll just go through some key pointers. If you do have any queries, feel free to stop me. And I mentioned, because I think we might overshot by, let's say, about 10 minutes. Those that need to leave, feel free to leave. If you want, you can stay and ask questions regarding TMA. If not, you can just watch the recording. All right. So let's go through the TMA questions. The first part is kind of praise the long-term solvency and asset management ratios for the 3 years. Generally, I think this part of the question, I think most people got the full marks if you use the required ratios that is given here, right? So if you use the ratios for long-term solvency, where is it? Debt to equity, we use this one and this one, should get the full answer. Asset management ratio, the turnovers ratio here. So these are your asset management ratios. Again, if you have any questions, it'll be better if you ask them. So if not, it'll just be I'm not sure what is required. Overall, I say question 1 is very well answered. Most people got full marks for part A. Part B, So the important part of part B is that you have to do a decomposition of the DuPont. Okay, so for this question, industry benchmark was not part of the answer because they just want over the last 3 years. So they just want you to compare over the last 3 years, but there is no mark deducted for industry benchmark. But I think it's a good practice to consider industry benchmark if it's given in the question. So like, let's say in your final exam, right? Because now GBA most likely, or not most likely, but it will not come out this kind of question, but final exam is possible that come out this kind of question. So if the question ever give you the industry benchmark, we should use industry benchmark to compare. But in this case, we don't have to. Yeah, thanks for your question. Part B, DuPont. So the thing about DuPont is that what's important is that you have to do the decomposition of DuPont. So I think some people just calculated ROE and then you just say, oh, ROE is decreasing, and then you just say it's decreasing, then that's all. But what's important for DuPont is that you need to say, okay, ROE is decreasing, fine, but why? Like, why is ROE decreasing? And that is where your DuPont explains to you, right? Whether is it because of the asset management or is it the profitability ratio that is causing your ROE to decrease. So if the thing is, if you miss out the explanation on like the reason what causes the ROE to decrease, maybe you just do calculation and then you just say ROE decrease without saying, okay, which component decreases the ROE. I think maybe like we will lose like 4 marks for the explanation, because the idea of DuPont is that you have to explain using the decompositions. Part C. So part C is actually not super tricky, but I realized that maybe because maybe you guys have not taken an accounting course, and therefore, or have taken but maybe forgotten, and therefore it became very, like, a lot of people lost marks on part C, or not lost a lot of marks, but just a few marks here and there. Why? Okay, so the question is, how does the current ratio and return on asset is affected by more sales and taking more debt? So when we have sales, what happens when we have sales? Okay, so this is a bit accounting. I'm just going in accounting. We need to debit AR or cash, right? AR meaning accounts receivable, credit, sales. What else do we have to do? We have to debit cost of goods sold, credit, inventory, right? So this is the sales. So I think quite a few people didn't realize that when you do a sales transaction, it will actually impact your current ratio, because current ratio is CA divided by CL, right? So in this sense, your CA, what's affecting your CA? Your CA is this component here, right? Cash and inventory. But when we do a sales, your CA, your net CA will increase. Why? Because sales are generally feedable, right? Meaning that your inventory might cost $100. Your cash that you receive from the sales maybe is $150. So you gain a $50, right? So net CA will increase, and therefore your current ratio will be affected. Right? Everyone can see this. So this is a bit, actually, it's not supposed to be tricky and not supposed to be difficult, but maybe the concept of from accounting wasn't taught or wasn't cemented too well. Okay, so this one component. Now, for long-term debt, when you think on debt, what do you do? What do you debit? You debit cash, because when you take debt, you get cash, right? You credit debt payable, right? Which is a liability, debt payable. So when you take on debt, can you see that it actually impacts your current ratio as well because your cash is affected? Now, for the return on asset, ROA, is the same thing. So ROA, we need to consider your sales and A being an asset. So you need to consider asset as well. All right. Any questions for this part C? Yeah, so part C is a bit more accounting, I would say. Okay, so question 2. This part, right? What's important is that because the question gives you all this information about shareholder, your answer must actually mention about this idea of shareholder. So some people, I think if you just mention generally about agency problem, you will probably lose maybe 1/3 of the marks, right? Because you need to bring in the context of the question here. But overall, I think the question has been done very well. So what's important to take note here is that statement 1, huge organization. So UOB is a huge organization and has agency problems should exist. So this question, I would say not really a trick, but if you notice that the reason why they give you this information is because it's important. Why? It's because the Wee family owns 10% of the company, which is very big, 10% for a big bank like UOB. So if the family is the owner and also the managers of the company, what is happening is that the agency problem would decrease because your family members owns the company and they are managers of the company. So that's the important part, that you need to know that the agency problem decrease. After that, then you can mention about how it still might be there, agency problem might be there because there is other kind of effects, right? I think there's one student mentioned about the idea of tunneling, which is a very good concept. So if you do research on agency problem, tunneling is what this kind of family firm does. So what tunneling? Tunneling means that because you own the company, like you are a family member, you own and manage the company, you are actually gaining resources from the subsidiaries of your company. So imagine you have a whole here, holding company, and you have various subsidiaries, right? Subsidiaries and subsidiaries here. So if you are the family here, I'm a family here, what do? I actually can tunnel money from the subsidiary below here, let's say subsidiary 1. I can tunnel money up to the whole co. And usually this is done by dividends upstreaming. And what can I do? I can actually tunnel risk, because remember we are in finance, right? So when we talk about rewards, we talk about risk. So yes, we can tunnel rewards up. We can tunnel risk down. So I think one student did a lot of maybe research about this concept. So the student mentioned that you can tunnel, which is like, yeah, I think that's a very good answer. You can basically you're tunneling the risk down, you tunnel the resources up. So what's happening is that because maybe here you own 50% and here you own 60%, your effect of the risk is mitigated by the percentage of cash flow that you own, right? 50%, 60%. So it's like 50 times 60. So it's like very little. But when you upstream dividends, you don't only upstream 50% dividends, right? When you upstream dividends, it's 100% of the dividends. Like if upstream let's say $100, upstream $100. You don't reduce the $100 by the percentage of ownership. So yeah, there's tunneling. So important part about 2A is that you need to mention the reduction in agency, simply because the family actually are managers of the firm. The shareholders are the managers of the firm. Everyone okay with this about agency problem? Okay. All right. So statement 2. So statement 2 is what's statement 2? Okay. Statement 2 is what I mentioned earlier, that so CFO should say that UOB should not focus on share price, because in doing so overemphasize on short-term profits. So this one, right, the main part that you need to talk about is that you need to know that for the what's the traditional goal of corporate finance or financial management is to maximize shareholder wealth. So this is the important part you need to know, that is maximize shareholder wealth. And when we maximize shareholder wealth, we necessarily maximize the share price, right? And when we maximize shareholder wealth, maximize share price, this actually is a long-term goal of the company. So this is the main part that you mentioned. Then after that, you can mention about how it might lead to short term, and because of emphasis on like stock options and all those things. But the main part is that you need to realize that by maximizing share price, you are actually maximizing shareholders' wealth, which is the long-term goal of the company, the traditional long-term goal. So after you mention that, then you can talk about all the ESG and all those things, then that's fine. Any questions? Okay, so let's just quickly go through question 3. So question 3, for green tech fund, I think everyone could get this. For net zero fund, this is a bit tricky. Why? Because they say net zero fund this investment can only be made in 2 years later. It means that this money will be in the bank for the first 2 years. So I think many people didn't realize that if you put the money in the bank for 2 years, you will need to do it, as in do this 3% monthly compounding for 2 years. Then on year 3, you put into the net zero fund at 6%. All right, so that's the difference. So you need to, for the first 2 years, you put it under the bank deposit at 3%, but this is monthly, so it's important. You need to do the conversion. Remember, I mentioned always go to the lowest denominator. You have to do that. Okay, second thing to take note for this type of question, some people, actually not some, but maybe a few, what they do is that they calculated, what is this effective annual rate. So I think effective annual rate is like 3.04% or something like that. Can't remember. So it's like, what they do is they take the lump sum, let's say 10,000 times 3.04% square times not 3.04. This can't be 3.04. It is 1.03. I think it's 1.03 because it's 3%. 1.034, something like that. Okay. So what some people did was 1.034% times square times 1.06 cube, because 3 years, right? Times 1 square, 12% thereafter. I think square. Oh, 3 plus 2, 5 cube. So cube. It's a bit messy, but anyone can point out what is the mistake here. Why can't you just multiply it in one line like this? Anyone knows? Maybe you did not do this method, which is good because it's incorrect. But why can't we do it this way? So we just multiply all the amount of returns. I guess okay. I think I know where you're coming from. So the issue here is that because you are not considering the compounding, you are just taking it as a simple interest. You're just multiplying it like this, right? Multiply in, multiply in. There's no compounding because what you're supposed to do is you need to take 10,000 multiplied by 1.034. You get the answer here. Now this answer, you multiply by 1.034 again, then you get another answer. Then this answer you multiply by 1.063. Multiply by 1.06, then you get another answer here. This answer multiplied by 1. You keep on doing like step by step. Then you consider issue of compounding. If you do this, you're not considering issue of compounding. So if you want to avoid doing steps like these, like keep on doing one by one, then you need to use time value of money to do it. All right. So some people use time value of money, that's fine. Then you can get the right answer. But if you just multiply like this in one line, you are assuming simple interest. So you're not considering compounding, the effect of compounding. The last question, part B, I think most people got it right. They got the answer correct. There are some calculation mistakes if you did not determine the n, what's the n amount, the number of years. But other than that, I think the question is quite direct. Most people got it right. You can use FV to convert everything to FV, or you can use PV, right? So everything go to PV, and you should get the right answer. All right, so I guess that's all. Today is a bit overshot. I'm sorry. And if you do have any questions for TMA, once I release the paper at the midnight, do let me know. You can always email me. Let me just pause the recording.